Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka. Well, it has been quite a volatile session. Of course, today being the weekly Nifty expiry, FNO expiry on the Nifty, a fair bit of volatility is anyway expected. But, we did see a fair bit of a dramatic turnaround because in the morning we were on the verge of reclaiming the 25,900 mark. But then, there was a complete about turn. The same thing happened yesterday, but yesterday it was on the upside, and today we saw a turn towards the downside. But the good part is that we still have 20 odd minutes to go for the markets to shut, and we have recouped some of the intraday losses. So we were precariously close to the 25,600 mark. We were on the verge of taking it out on the downside, but thankfully that didn't happen, and now we are back above that 25,700 handle. In fact, at the current juncture on the screens, I can just see a 60-point cut on the index. At one point in time, the cut was over 100 points. It has in fact been a 140 to 150 point range that we have been working with today, and right now it's a 60-point cut. So 25,730. That's where we are at when it comes to the Nifty. The Sensex is down somewhere around 230 points. Mid cap index, it was seeing sharp cuts in excess of 1%, but it has done extremely well in the last few minutes. It has recouped almost all of its losses, just about 90 points down on the Nifty mid cap index, and much of it has to be much of the recovery that we have seen in the market from the day's low, it can be attributed to the financials and banking lot, because the Nifty Bank Index has staged a very good comeback. It has in fact reclaimed that 59,550 mark. It's in fact very close to that 59,600 mark as well. It's up over 140 points, and the breadth of the market also deserves mention. It was fairly poor. We started on a very strong footing, just let me just remind you that. But then things turned around. We saw the breadth worsening quite a bit. But once again, it's even Stevens right now, 1:1. That's the NSE advanced decline ratio. So we've seen a good amount of recovery coming in from the day's low. In terms of sectors, as I said, banking and financial is doing well. So PSU Bank Index, that's the top sectoral mover. IT is also doing fairly well for itself, 0.4% kind of gains. TCS was trading in the red, HCL Tech was flat, but other IT names were kind of buzzing, which is what is keeping the IT sector afloat. Metals doing well. Dollar index, of course, has cooled off, and that's aiding sentiment for metal stocks. On the downside, however, real estate, there's no solace for this particular index. Real estate index had severely underperformed in 2025, and it continues in 2026 as well. Pharma, autos, FMCG are some of the other sectors that are on the back foot. But the good part is that, yes, I know the one day up move that we saw kind of fizzled out, but yesterday's swing low was 25,473. Thankfully, we are still far away from that level, so not sure whether one should really worry or panic so much. But a lot of this volatility that we saw today is attributable to the fact that it is weekly expiry day. But of course, to understand where things are headed from here and what one should be doing in this leg of volatility, extreme volatility that we are witnessing on the Lal Street, let me bring on board Sandip Agarwal, who's the fund manager at Sowilo Investment Managers. Sandip, lovely chatting with you this afternoon. Yesterday, of course, the sentiment turned around because of commentary coming in from Sergio Gore, in terms of how he plans to take things forward when it comes to the India-US relationship. That really triggered the bulls, and we saw a very, very solid comeback in the market. But there were questions as to whether or not it will sustain, and that's exactly what that's something that has really not happened. Would you attribute today's volatility to FNO expiry, or would you say that the kind of bounce we saw yesterday was short-lived, and we need to see more concrete details when it comes to trade deals to actually say that the sentiment has turned around?
Hey, hi, good afternoon, and thanks for having me on the show. So I will just highlight few things, right? So we have to remember that the large part of the impact which was there because of initial tariff hike for many companies which has exposure to the US. A lot of that has come into numbers, and even if they would not have come in numbers, the commentary or the update from management has led to analysts making those adjustments in the numbers, and because of that, huge cuts have already happened, and that is the reason you will see a lot of micro caps, small caps, and mid caps have corrected a lot. although at index level, mid cap index may not look very low. So that is one. So large part of the cuts have happened, and this kind of moves when happen, what we are seeing in last few days is that now it is a place where I think there is a buyer in even mid cap and small cap at at regular interval, and because of that, whatever goes down sharply, it is being absorbed. So I think this is a typical consolidation phase of a bear market in the small or micro cap which we are witnessing. And I think fundamentally the companies which are good, which deliver good numbers, good management, good quality products to offer, I think they will all recover very quickly and very fast, as some clarity on the tariff comes, or some relief in budget comes. So I think people are looking forward to that. Also remember, Indian investors have matured over time. They have seen so many cycles, so they are very clear that whenever the time is appropriate, whenever there is a deep correction, they will definitely go ahead and buy what they want to buy. And I think that is what is playing out. Also incrementally, we hear a lot of seasoned fund managers and CIOs now coming on channels and saying that small cap and mid cap have entered their comfort zone to buy versus what it was a year back when they were extraordinarily expensive. I think all those things have started playing together, and I think Indian market has long way to go, because we are at almost bottom of the cycle in terms of FI selling. Lot of selling has happened. I don't know. I can't say that they will not sell more, but I think a large part of selling has been done. Our economy is doing quite well. The inflation rates are contained. RBI has a lot of scope to cut rates. So all the positive things which we can think of, I think they are coming, and people are pricing all those things also at the same time when they are pricing in a depreciating rupee in the current environment.
Okay. So you concur with the fact that when allocating fresh money, one should look at broader markets, because you said that mid and small caps. That's the hope that mid and small caps will do better this year.
So if you see fundamentally, the growth rate in mid and small cap has been higher than large cap, even last few quarters also, and I think that trend will continue. Only thing is that in large cap, what happens, your margin of safety, or it is a hiding place and more liquid, so you can get off your big positions and all those things. So that is the advantage. And that is the reason a lot of money gets allocated there. While in mid and small cap, because of the size of the market cap, there is a liquidity issue to buy also, and there is a liquidity issue to sell also, and we face that challenge in mid and small caps, and that challenge cannot be ruled out even further. So you will see very choppy mid and small cap movements in next few months also. But I believe that fundamentally mid and small cap, because of the base at which they are operating, they will definitely deliver better growth than large cap, and now they are they have started looking better in peg ratios than large cap. Let me put it that way. And for us, peg ratio is much more important than the PE ratios.
Okay, PEG ratio much more important than the P ratio. Before I talk about the structural themes to look at, want to understand your verdict on the numbers that have come out from the IT stable. TCS, HCL Tech, of course, steady quarter. HCL Tech more so, given the fact that it has managed to beat expectations in terms of margins and revenue, and of course, it has also upgraded its guidance. For TCS, of course, we've seen that one-time hit on bottom line as a result of the labor code. The street view is fairly cautious, but I was just going through Macquarie report. They are pretty upbeat on TCS. Their price target indicates almost a 50% upside from current levels. After the kind of up move we've seen in IT since last quarter, in the matter of a quarter, we've seen a good rally coming in IT, right? So post that, do you see headroom for upside right now, or would you say that a couple of more quarters would be needed, or would need to unfold before we see more upside from here? What is your sense?
So, every stock, how it will perform is a factor of two things: the earnings growth and the multiple one will like to assign. So, very tough to give a call on multiple, because different fund managers have different kind of perspective view, and global economy and global macros and Indian macros, everything plays a role, including currency into that. So very tough to give that call. But let me give you a perspective that, the penetration level of Indian IT in the largest market in US in the sourcing side is very high. Even within the global sourcing, if you take pure IT services, will be more than 90% market share, and if you include BPO, will be 70-75%. So it is a very big number which we are already there. So the chances of growth from here is very low for the sector as a whole. Secondly, the almost 8 or 10 years or more than 10 years, we have seen substantial growth in the services revenue at global IT spends, and it went up substantially during the digital times. But last 1.5, 2 years since AI has come, the hardware, after 10, 12 years of decline, it has taken a front sheet and it has started growing in last 1.5, 2 years, and that is the reason you see the big moves in the Nvidias and other stocks. I believe that once this hardware replacement cycle is over, you will see some spend again coming back in the software side, and that is the time probably when you will see that all the companies benefit. But remember that there are two challenges to the Indian IT at a macro level. One, the market is highly penetrated. We have the lion's share of in the global sourcing market, and that industry, even if it comes back post hardware replacement, the growth will be minuscule, 2-3% at global level, and maybe India level 6-7%, and this company can do 7-8%, let's say hypothetically. Second is that large caps also have a double whammy from the fact that earlier, till before COVID, the deal, who can participate in which deal, was decided by the balance sheet size, the past execution track record of the size of the order book they have executed. Now those conditions have been completely taken away. So the biggest challenge large cap Indian IT companies are facing is that from 3-4 vendors in a deal, now there are 15-20 vendors in every deal, because the size of the companies are no more important in any deal. And that is the reason that even the small companies are competing with the largest company in the sector whenever a new deal is coming. So I think this challenge is real and very tough to get over. So I would put it this way, that I think that the large cap Indian IT is a sector at best 5-6% growth for long term, and the mid cap can be 10-11% growth, and the small cap could be 14-15% growth. And in terms of multiple, the peg ratios are highest in mid cap, followed by large cap, and then small cap. So I think now time has come where what you saw in mid cap between 2021 to 24, the way they went up 10-12x in very short span of time, maybe small cap can, I will not say 10x, but they can do better, much better in terms of return, followed by some returns in mid cap and very low return in the large cap. It is a very, very matured industry.
Okay, point taken. But let's also talk about platform companies, right? Especially the quick commerce ones. Sources say that Labour Minister has nudged companies to discontinue branding of 10-minute delivery to protect the gig workers, right? Now, meetings were held with leading platforms, including the likes of Blinkit, Zepto, Zomato, Swiggy, etc. Quick commerce companies haven't really reacted yet. But what would this really mean? Because if the 10-minute branding goes, do they not lose their edge? And of course, this will also impact their profitability, right? So, if this really happens to remove the 10-minute branding, what would this really mean? And how do you see this development if at all it happens?
No, so I think that whether 10-minute branding stays or goes, it will have a temporary impact. See, what has happened is this companies, these platforms have changed the way people are living their life, and that impact cannot be taken away by changing the branding. So today, if you want something, means we are seeing in our daily life at morning 6, if I want something, we do Blinkit, Insta, and we get the things. So I think that cannot be taken away by just changing the branding. So I think these platforms are doing an excellent job. All this noise around this, some impact will be there, some cost increase can be there, but this is the way the human lives have changed. You will be surprised to know that more than 8 to 10 million people have got employed on through platforms in various businesses in the country in last few years. So it is a very big population which is employed. And obviously, when you grow to such a scale, we have seen that in IT services software side in late 90s, that you have to bring a lot of changes to the system process and everything. I think those things will come, the insurance, what they are asking, security and all those things, there will be some cost impact. I think the habit which already people have, they won't mind paying 2 rupees extra for delivery or 5 rupees extra, and that is all we are talking about in change of cost. So yes, in near term that might look difficult and all that, but in long run, I don't think this makes any dent to the structural theme or structural thesis of the platform businesses.
Okay, all right, point taken. And lastly, which are the structural growth themes that could shape the next phase of wealth creation according to you? Where would you look at when you spot themes right now?
So we are very clear that we will have to be very aggressively into the capital markets theme, because we believe that the penetration of capital markets is still very low, and you compare the AUMs of international of other countries like US and all, and with Indian AMC, there is a huge difference. So we have a long way to go. Equity penetration is very low. So we want to be very aggressively, and we have been consistently investing in the capital market theme for quite some time. And second is manufacturing. We believe that we have a challenge for last few quarters in the private investment side and private capex side, and that is the reason the manufacturing stocks have made a big negative return. But over a long term, I think for us, growth will come in manufacturing. There is a lot of focus of everyone towards that. So we are very, very aggressively focused on manufacturing. We are focused on capital markets. We are focused also in banking side because we believe the NPA cycle, which is there currently, is one of the best cycle. There is virtually not much credit cost. It is very good. So and credit growth is also going to pick up with private capex coming in. So these are few themes which we love a lot. Although we do see we also like the pharma theme, but we are little away from the CDMO now because it has gone very expensive. So we have got out of the CDMO theme. Now we have gone back to the generics theme where the stocks are very, very reasonably priced. And we are right now not preferring any FMCG or CDMO thing or IT. Though we have also some small exposure to the platforms because we love those businesses.
Okay, all right. Taking your point, all those sectors that you mentioned on your radar. But with that, Sandip would like to thank you for taking our time and joining in. Look forward to a longer conversation pretty soon. I had a whole lot of questions that I wanted to ask, but I'll save it for next time. Thank you for joining in this afternoon.
Thank you.
Thanks a lot. All right, let's shift focus to the market then. Just talking about the recovery that we have seen in the last few minutes. Nifty has staged a triple-digit rebound from the day's low, 126 point, just to be precise. Kind of recovery from the day's low, 25,730 on your screens. Even the mid-cap index, and that has staged a very, very sharp rebound. Over 550 point rebound coming in on the Nifty mid-cap index from its day's low. Breadth of the market, at one point in time, it was fairly poor. Although we started on a strong note when it comes to the market breadth, but now it's back to even Stevens, marginally in favor of declines, but nothing really to worry about. 1461 advances to 1476 declines, so it's almost even Stevens. So yes, one would take heart from the kind of recovery we've seen from the day's low today. The Nifty Bank Index cruising above that 59,500 mark. It's up somewhere around 0.2%. That's one big factor, one big contributor to the recovery that we have seen in the market from the day's low. In terms of sectors, as I already mentioned, we have other financials also doing well. PSU banks were topping the list of sectoral gainers, but real estate continues to get hammered, right? Last year we saw severe underperformance coming in from the real estate basket, and this year hasn't been good either. In the somewhere in the middle of the day we saw real estate staging a good recovery, trading with good gains, but that didn't really extend. And of course today, right now, we are seeing Nifty Realty among the biggest laggards in terms of sectors. But on that note, to take stock of the last 4 minutes of trade, I have with me Osho Krishan, of Angel One joining in. Osho, great to be chatting with you. But one would have thought after the kind of sell-off we saw around midday, one would have thought that yesterday's one-day bounce was just like a one-day wonder. But given the kind of recovery we've staged from the day's low, how are you looking at the setup for tomorrow?
Very good afternoon, Nandita. Firstly, thank you for having me at the show. Well, yes, no doubt we are witnessing a very volatile trading session. The last couple of sessions has been very volatile. But overall, what we are witnessing that at the lower end, there is some kind of resilience from the bulls. So I'm expecting that in the short-term perspective, the view remains on the similar manner that on the lower end, on technical front, the 100 exponential moving average approximately around the zone of 25,600 and 550 should be providing very strong cushioning to the counter, and on the higher end until we again see some kind of strong movement beyond the 50-day exponential moving average, which is approximately around the zone of 25,900 spot levels. So till that time there can be some kind of both ways movement, but that will be providing opportunity for the day traders because we are witnessing a quite good moves, and for a trader who is looking for such movement that has been taking place after a very long period. So I'm expecting that if the same could happen for another 2 to 3 trading session, that will be very much aligned to the trader's perspective. But overall, I'm quite bullish, not very much pessimistic as of now, but my bullish view will be more aggressive once it breaches the zone of 25,900 on a decisive manner.
25,900 on a decisive manner. Today, we almost breached that level, but that was not to be. Soon after, we saw markets take a strong U-turn. Just about 2 minutes to go. Osho, anything that was on your radar or that you are keeping on your radar for tomorrow in terms of stock ideas?
Yes, definitely. There are a few counters which are looking very positive. First one is Bajaj Finserv. Bajaj Finserv has been seeing some kind of reversal from the 200 exponential moving average. So that counter should be kept into radar and even can be seen as a BTST kind of a trade. It is hovering currently around the zone of 2010 odd levels. So one can look for buying opportunity in the counter. Approximately 1975 should be seen as the stop loss. On the higher end, 2060 will be the immediate target that one can expect. And the other one is Eternal. Eternal has also seen a very strong reversal on the technical front, and I'm expecting that this momentum should continue on the short-term perspective. 300 is the first target, followed by 306 from short-term point of view.
Okay, Eternal and Bajaj Finserv, those are the two stocks to keep on your radar. Of course, also could double up as a buy today, sell tomorrow, BTST strategy. But hold that thought, Osho, just taking stock of market close before we discuss more stocks and how things are looking like when it comes to individual stocks. Look at the Nifty. We are shutting shop above that 25,700 mark, which is a good sign. Nevertheless, 70 point down, but still it's a good rebound from the day's low. We were on the verge of breaking below 25,600, but thankfully that didn't happen. Mid cap index also with cuts of somewhere around 0.3%, but it did well to recover over 500 points from the day's low. Sensex ending down by 260 points at 83,609. Bank Nifty ending the day in the green, 59,500. I mean 545. That's where it's at. So we are shutting shop above 59,500, and that's a good thing because that level was being mentioned by a lot of analysts I've spoken to. In fact, if you look at the breadth, marginally skewed in favor of gainers. Even Stevens 1:1. So that's also a good thing, a good takeaway. Of course, there was a fair bit of volatility today because it was Nifty expiry, but just to remind you, tomorrow would be Sensex expiry because Thursday is a market holiday on account of BMC elections. So the expiry day for Sensex has been shifted to tomorrow, preponed by a day, Thursday being a holiday. But in terms of other sectors, quickly take a look at the texture is looking like at close. PSU banks almost 1% gain, IT over 0.5% gain. Metals, banks, these are some of the sectors that ended the day in the green. What didn't do well were the likes of Nifty Defense, that was also down in excess of 1%. Realty index down 1%. Pharma, autos, FMCG, energy as well were down in trade. In terms of individual movers, then just quickly take stock of some of the stocks that were on the heavyweight side that didn't do all that well. L&T, that stock was down 3.5%. Of course, at one point in time, it was down almost 5% on the back of some news flow. But L&T came out with a clarification after that. It kind of paid some of those losses. But nevertheless, among the top laggards, L&T down 3.5%. Reliance Industries also down 2%. So all these heavyweights, were not really providing any kind of support to the index today. Even ITC was down 1%. Axis Bank was down. Maruti Suzuki, Dr. Reddy's, the Cipla, these are some of the stocks that didn't do well. On the upside, we have ONGC that picked up pace and that ended with gains of 3.5%. Eternal, as Osho also mentioned, it's one of his picks. That stock was up 3.5%. TCS, HCL Tech were muted in trade, but look at Tech Mahindra, that was among the top Nifty gainers, up almost 2%. ICICI Bank provided support to the Nifty Bank index today. That stock was up 1.5%. SBI 1.5%. TCS, although at one point in time it was pretty flat, but picked up traction, ended higher by almost 0.9%. And Bajaj Auto, Apollo Hospital, Nestle, Wipro, these were among the other gainers. But what do you make of the movement on shares of ONGC, Osho? 3.5% gains. Crude prices also edging higher amid flare-up intentions in Iran. So ONGC, would you look at ONGC within the oil and gas pack?
Definitely, there has been very strong traction, especially in today's trading session. The counter have seen a very strong momentum, nearly 3.5% on the higher end. And technically, also there have been multiple developments, positive developments for the counter. Firstly, it has emerged above the 20, 50, and 100 exponential moving average in a single day. So that's a very positive thing that to be seen in a single day for a counter. So I'm expecting that the momentum can be seen to get aggravated because that has been backed by very strong volume. So one can look for opportunity in this counter. I'm expecting 252 followed by 254 as the first or intermediate hurdle or as a target. If it breaches the zone of 254, then from there onwards we can see some kind of continued momentum over a period of time. But from a shorter term perspective, for a kind of a BTST or maybe a positional 2 to 3 days kind of a bit, one can look for buying opportunity. 254 will be the immediate target that one can expect in the quarter.
Okay, ONGC looking good on the charts. But let's talk about an ICICI Pru as well. It reported numbers today. Good set of numbers. Annual premium equivalent was up 4%. The value of new business that grew 19%, and VNB margin also came in higher at almost 25% vis-a-vis 21.2% on a year-on-year basis. Stock ended flat, but it has seen good traction in the last 3 months. How would you look at this stock? Would you prefer this stock within the life insurance space? And which are the next targets to watch out for? Not very far from its 52-week high of 706 either.
Technically, this counter is at a very strong resistance level. Historically, also we have seen the zone of 680 to have seen some kind of a strong rejection. And again, in the past 5 trading sessions, the counter has seen some kind of volatility around the same level. So I will be waiting for a decisive breakthrough of 680. Any levels above 695 or 700 odd levels should be seen as an buying opportunity because that will confirm a trend, a reversal trend of double bottom formation in this counter. So my advice will be to wait for a conclusive buying opportunity. If it moves beyond the zone of 695, then one can look for buying opportunity in the counter. Else wait for some kind of correction because technically the counter have already seen a decent movement from the zone of 620 towards 680. So technical parameters are quite overstretched at current point of perspective. So overall, one should either wait for some kind of correction. If it happens, then 640, 630 will be the advisable level to start accumulating the counter. Or if there will be a breakout, then 695 will be the next levels from where one can look for buying opportunity in the counter.
Okay, that's about ICICI Pru. But there's another result reaction that I want to discuss with you. It's GTPL Hathway. That stock, I think plummeted somewhere around 17% from the day's high. At one point in time, the stock was up somewhere around 8-9%. Numbers were fairly steady. So, what do you make of this sudden reversal? Sharp sell-off coming in. What just happened here?
There might be volatility because of the numbers, but overall, technically, if I have to quote, then this counter was already into a weaker strength. It was hovering below the short-term moving average. So technically, there was no positive sentiment associated to the counter, but with the kind of closure that this stock has given, it has given a breakdown from the historical support of nearly 95, 96 odd level. So I'm expecting that with the kind of correction, if something aggravates or there will be a follow-up sell-off in the counter, then we can see a further correction towards the zone of 74 in the near term period. So technically it is looking very weak. If there will be any kind of bounce back aftermath of the quarterly earnings, then there may be a possibility of a decent pullback, but as of now it will be avoided from a technical point of
view. What about Balaji Amines? Stock was on a tear today, up 11%. And of course, that has taken the monthly gain, 1 month gain up to 10%, but the stock hasn't done well. In the last 6 months or so, it has shaved off 30% or so. Would you look at chasing the stock based on the recent price action, or would you steer clear?
See, overall, this will be a kind of a reversal pattern which the counter is into formation into, but overall I will be waiting for a decisive and sustainable move beyond the zone of 1250 followed by 1280. Then only we can see some kind of counter trend in this stock. Overall, looking at the technical setup, it is at a historical support levels. So at current levels, it is not advisable to exit from the counter. If someone is already holding position, then it will be advisable to stay invested. But overall, my conviction will increase once it surpasses the zone of 1260 on a decisive manner. Then from there onwards, we can see a kind of a counter trend in this stock, and one can look for buying opportunity from short to medium term point of view.
Okay, that's about Balaji Mines. 1250, that would be a crucial level to watch out for on Balaji Mines to call it a trend reversal, really. But what about the cigarette makers, the likes of Godfrey Phillips, ITC? Of course, since the start, it not been a great start to the year for these stocks. They got a rude shock on the first itself in terms of the new excise duty. If you look at the month to date returns, likes of ITC, Godrej, they have shaved off 13, 20, 13, 14, 15% or so. But would you look at the dip as buying opportunity? Because today we saw a fair bit of action, both in terms of pricing and volume on Godfrey Phillips. Worth a look at this juncture or avoid?
Both the counters are into a steep correction, so it won't be advisable to catch the falling knife for the time being. Better to wait for a stabilization in both the counters. For ITC, it has tested 52 weeks low in today's trading session, so I'm expecting that it might aggravate in the short term period. Looking at the historical trend, 320, 315 will be the next support zone for ITC. So if it stabilizes near the zone of 320, then one may look for accumulation in the counter, but that too in a staggered manner, not very aggressively. And same applies for Godfrey Philip because this counter have also seen a strong correction. No doubt today the counter was having a kind of a pullback, but overall the strength remains on the lower end. So I expect that if there will be any kind of a stabilization near the zone of 2100 on the lower end, then one may look for accumulation in the counter. Until that time, better to stay sidelines.
Okay, not advisable to catch a falling knife, and of course you have to take stock of the levels there to really make a decision as to whether you want to enter into these stocks or not. But talk about L&T as well. The stock had started seeing traction, right? But today, of course, there were some reports, in terms of the Middle East Economic Digest, wherein they reported that Kuwait may be discussing cancellation of oil project tenders worth $8.5 billion, and they could be looking to rebid those tenders as well. Of course, L&T was one of, according to analysts, L&T was one of the L1 bidders for projects worth over $4.5 billion. So I think that is something that led to the kind of correction we saw in shares of L&T. But the company came out with a clarification also. They've said that projects referred to in the report were not part of the company's order book. I think post that we saw 1.5% kind of recovery from the day's low in the stock of L&T. But the stock has started seeing some traction in recent times, right? How would you look at today's move, and what would you do with the stock?
See, overall, technically, if I have to speak, then this counter is retesting the neckline of the breakout, because the breakout on the weekly and monthly time frame was approximately around the zone of 3800. So I will be considering the correction as healthy and opportunity to reaccumulate the counter. So overall, any dip towards the zone of 3800 should be seen as buying opportunity in L&T, and in a staggered manner, definitely, because one should not again be very much aggressive with the kind of correction the counter is into. So one should start accumulating in a staggered manner around the zone of 3800. Technically, it will be a very healthy correction, and any further consolidation or even stagnation around the same levels 3800 can provide very strong technical perspective from an accumulation point of time. So it will be advisable to start accumulating the counter from short to medium term perspective.
Okay, start accumulating from short to medium term perspective. That's L&T for you. But let's talk about the badgered, beaten down real estate space. Godrej Properties in particular, I think hit a fresh 52-week low today. The sector itself has been hammered out of shape. Any thoughts? Do you think that the worst may be over chartically? How is the setup looking like, particularly for Godrej Properties? And within the realty pack, what are you really looking at right now?
As of now, the whole pack is kind of witnessing a kind of corrective phase. So Godrej property, to be specific, as it has witnessed a breakdown in today's trading session, the zone of nearly 1950, 1920 was a strong support levels, but the breakdown below this has quite dampened the technical structure. So I'm expecting that if there will be further correction, then 1800, 1780 will be the next potential target on the lower end. So that will be the target that one can expect from a short-term point of view as a short seller. But if there will be any kind of pullback or recovery, which can give a kind of a momentum back towards the 1950 odd levels, then only one can look for buying opportunity. As of now, it is into a deep bearish sentiment. So better to look for short opportunity in this counter. Any bounce towards the zone of 1900, 1920 could be seen as a selling opportunity in this counter.
Okay, that's the view on Godrej Properties. But I want to get in your attention on shares of a PVR Inox. Ended higher by 7% or so. Of course, the kind of revenues or the kind of response that Dhurandhar has got on the box office. Would you expect this stock to emerge as a Dhurandhar this year? Do you think this will revive the fortunes of the stock of a PVR Inox? And on the charts, which is the next level to watch out for, it's cleared the 1000 level on the upside. Would you expect 1100 kind of levels anytime soon, given the kind of success that movie has seen?
See, overall, Dhurandhar has been a very good movie, but looking at the stock price of PVR, there has been no correlation between the popularity of Dhurandhar movie and this counter. So overall, there has been very strong flat to negative kind of movement that has been seen in PVR. So I'm expecting that technically the counter is still into oversold terrain. So there can be some kind of pullback that can be seen in the short term period, but not very positive in this counter. The short term pullback can see some kind of movement towards the zone of 1120 to 1130, but that is a very strong resistance level. If it surpasses that zone on a decisive and a sustained manner, then only one can look for buying opportunity. Till that time, better to stay sidelines from this counter.
Okay, so no such luck for stock of PVR Inox. Of course, the fortunes of this stock remains on the downside, not very far from its 52-week low, but at least it has cleared 1000 level on the upside. But some of the shares of capital market plays like Motilal Oswal, a lot of other names as well were doing fairly well today. And if you talk about capital market as a theme, we've seen good rally coming in for a BSE as well. Recently, I think I was discussing it with some technical expert when we were mentioning that it has crossed all those key moving averages as well, and it's trading well above them. Any of these names that excite you within the capital market theme? Anything, AMC, brokerage, even exchange for that matter? A couple of them, if you could list out.
Various counters are looking very positive to me. The first one, which is having a very decent movement, is Anand Rathi Wealth. So that is a decent counter, and I'm expecting that in the coming period, it might see some kind of a strong momentum once it breaches the zone of 3200. So that will be the first counter which is into the radar. Then again, BSE is also definitely looking very positive above the moving averages. So there is a strong possibility for the counter to see some kind of a strong traction in the coming period. Now, from those counters which have seen a decent correction and there is a kind of reversal which is expected, so CDSL will be the pick from a reversal point of view, because the counter have already seen a decent correction. The counter is at a historical support levels, and technically also the parameters are approaching towards the oversold terrain. So I'm expecting that in the coming period, not at current levels, but in the short term period, there is a possibility of a reversal in CDSL as well. So any breakout above the zone of 1480 to 1500 will be providing a strong momentum in this counter, and one then may look for buying opportunity from a short term point of view.
Okay, those are some of the capital market plays to keep on your radar. But what about the likes of Dixon Tech? Another 5% down today. We've seen a fair bit of correction in some of these EMS names. Are they anywhere close to their bottom?
Technically, the counter is looking very weak. There has been significant breakdowns in the counter one by one. All the technical support has been broken down in Dixon technology. So I'm expecting that with the kind of momentum, there is a strong possibility for a continued sell-off in the counter. Although technically there has been some kind of developments which might signal an early signals for a reversal, but it will be advisable to stay sidelines from the counter until we see a kind of a stability on the lower end as well. So on the technical front or on the levels front, 10,900 will be the support levels. And if it breaches that level also, then there should be a definite exit from the counter. If not, then there might be a possibility of counter trend from a short to medium term perspective.
Okay. Another counter that's catching my attention is AU Small. Of course, this stock has done extremely well. It has been an outperformer. But in recent times, we've seen some correction. Would you advise, traders and investors rather to wait for more dips to get into it? Is there a little bit of more correction in store?
There has been very secular uptrend in this counter. There was a cycle of higher highs only on the daily time frame chart. So better to wait for a healthy correction, because post the breakout it witnessed around the zone of 830, 820, there has been no looking down for the counter. So better to wait for a healthy correction. Technically, there has been a very strong stagnation at the overbought terrain, and from there onwards, with the kind of today's development, there has been a breakdown on the technical front. So I'm expecting that in the short term period, there is a possibility of some pull off or some profit booking from current levels. But technically, the zone of 900 followed by 880 will be an apt zone to start accumulating. At present levels, better to start booking profit if someone is already holding position.
Okay, that's about AU Small Finance. And lastly, what do you do with, how have you approached IT stocks? Of course, today HCL Tech, TCS were flat for a better part of the session, but towards the end we saw TCS picking up traction. But other IT stocks like Tech Mahindra and even Wipro for that matter were quite upbeat. Tomorrow we have Infosys reporting numbers. Ahead of Infosys numbers, how would you be, placed, or how would you be positioned in some of these IT names?
Majority of the IT space counters are into a strong consolidation zone after the rally that we have seen in the recent period. Majority of the counters have underwent into a strong consolidation. But the positive side is they are hovering above the short and medium term moving average. So overall, the strength is still there in the counter, but definitely now the volatility will trigger in once the quarter earning result will start coming out for majority of the counters. So there will be volatility, but from a medium to long term perspective, I am quite bullish. There might be some kind of fluctuations in the short term period, so that could be seen as an opportunity if there will be any kind of correction in majority of the heavyweight counters.
Okay, all right, point taken. With that, Osho, would like to thank you for taking out time and joining in this afternoon. Always a pleasure, and I look forward to our next interaction as well. Have a great evening.
Thank you so much.
Thanks a lot. On that note, just shifting focus to some stocks that were in focus today. Of course, there were quite a few, but let's take stock of what the street verdict has been like for TCS, because it's a bellwether, right? And it handed in a fairly steady show, although the bottom line did take a hit on the back of multiple one-offs, but other than that, revenues and margins were largely in line. In fact, even in terms of their annualized AI revenue, they gave us some color again. Of course, in their December analyst meet, they had said that it was $1.5 billion. So yesterday they pointed out that the annualized AI revenue stood at $1.8 billion in CC terms. Demand environment continued to improve in Q3. That's what the management pointed out. And they've said that one key pillar for the company will be participating in the larger ecosystem, which means being more acquisitive going forward. But they won't be looking to acquire companies just to contribute to the bottom line and top line. The focus will be on buyouts that could create strong energies and deliver greater value to customers. That's what the MD and CEO told CNBC TV 18 in an interview with them. In fact, they are expecting calendar year 2026 to perform better than what the company did in calendar year 25. In fact, if you look at the street verdict, most of them are fairly cautious because they want more color on how overseas revenue will pan out. But Macquarie is the most bullish, because here they have a target which is the highest on street of 4,800 rupees per share, which implies a near 50% upside from current levels. But we have other brokerages who are a little more cautious, because Citi has retained its sell call. The target price is 3,020 rupees per share. They've noted the fact that the company has reported an inline set of quarter, excluding of course all the exceptionals in terms of one-off hit on bottom line. But international business growth, may disappoint going forward, because it is fairly muted. That's what Citi has pointed out. And they've also pointed out that equipment and software are the segments that have driven nearly half of the quarter-on-quarter growth. In terms of Nomura, they have a neutral call. Target price is a little higher here, 3,300 rupees per share. They've noted the fact that the company has reported a modest beat on revenue as well as margins. But according to them, visibility on the growth leadership as to where it will come from going forward, that's something that remains limited. And they have also said that any meaningful margin expansion in FY27 appears unlikely without stronger growth. Remember, the management had earlier guided for, not guided, they don't really give guidance, but they had provided us some color saying that 26 to 28% margin is something that they are aiming for. But according to analysts, that looks unlikely at the current juncture for FY27. Move on to HSBC, that has a hold call. Target price is at 3,450 rupees per share. They've said that there is no material change in growth trends in this quarter, and they've also pointed the fact that margin remains solid, and the commentary in terms of demand was fairly positive. Management said that Q2 saw improvement in demand, and Q3 as well saw some improvement. And according to the brokerage HSBC, the risk reward at the current juncture appears balanced for TCS. Lastly, CLSA has an outperform call here, and the target price is in excess of 3,590 rupees per share. In another development, let's move on to some macro development then. 10-year bond yields, they jumped 5 basis points to 6.63% today. And this was, of course, because of a reason. Bloomberg has said that Indian bonds will not be included in the Bloomberg Global Aggregate Index, but they've said that they will likely keep the review open and ongoing. It has also said that it would update the review by mid-2026. Now, Bloomberg said that the operational and market infrastructure gaps need further review before inclusion. Of course, Goldman Sachs had estimated the inclusion could bring about somewhere around $10 to $20 billion of inflows into the Indian debt market. Of course, this has come as a disappointment to the bond market, which is why we saw a reaction of that sort. But yes, that's something that, of course, the bond market took stock of. But yes, today it was a fairly volatile day, and tomorrow promises to be another volatile session. As I mentioned, that it's Sensex expiry tomorrow, so brace for some more volatility. But the good part is that the recent swing low that we had made of below 25,500, at least we are far off from that level. So that's something that one should take heart from, and also the fact that we saw a good recovery come by in the last half an hour to 40 minutes of trade. Good thing that we ended above that 25,700 mark, and of course not to forget the kind of recovery we saw in the broader end of the markets, with breadth improving and the mid cap index paring its losses quite significantly of 500 points from days low. But tomorrow, of course, aside of the Sensex expiry, Infosys will be reporting numbers post market hours. We'll take stock of that, and of course we will be getting you coverage on that as well. So important day tomorrow as well, before that holiday on Thursday on account of BMC elections. But with that, we're completely timed out on Closing Bell. Thanks a lot for tuning in. Stay tuned to Moneycontrol for all your other news and updates. Have a great evening, and come back and join us tomorrow morning at 9 a.m. Thank you.